Hey guys, welcome back. So today in this video, we'll be looking at some of the top regulations in banking and finance and how they may affect your blockchain investment decisions. So for example, if you know that there is some regulation about requiring banks to track more of their transactions, then maybe a blockchain project which builds solutions for that specific purpose may have better adoption in the market. So that's what you'll be learning in this video. If you understand this, then you may be able to make better investments, or you also may be able to not invest in some things where the regulations may not be so friendly towards. And at the end of the video, I'll also be giving you some suggestions on some coins to look at based on the regulations that we look at. So yeah, I hope you enjoy the video and let's jump right in. So let's also just understand what regulations are just to start off. So regulations are basically some rules set out by the government to kind of steer, control, manage some societal behavior in a way that is usually safe for their citizens. And the government has ways of monitoring and enforcing those rules. So one example here is smoke-free areas. Obviously, I'm guessing you've seen this a few times. But why are we interested in regulations as blockchain investors? Well, the thing with blockchain is that because blockchain is so new and it's based off this sort of decentralized architecture or way of doing things, a lot of the regulations that we have in the world today don't particularly apply, or they don't particularly fit blockchain in a way that is conducive to blockchain adoption. Because a lot of the regulations, they were built with a centralized model in mind. So an example would be KYC and AML laws, so know your customer and anti-money laundering laws. And how that is centralized is that they're designed to protect society against nefarious individuals, and how they're implemented or how people are monitored through that is that the government gets banks to collect identity or personal information about all their users, and through that they can see the fund, where those funds are being used, and whether those funds are actually being used by nefarious individuals. The banks are the central intermediary, kind of doing all the monitoring for the government. As you can see here on the screen here, so the example is basically, the blockchain is the box here, and then the current regulations is the circle. The circle doesn't entirely fit the box. It still works, but it's not the best it could be. So what does this mean? Things could be better for blockchain. If the circle actually fit the square, then maybe the environment would be more conducive to blockchain growth, and there'd be more adoption. People would be less confused. Businesses would be less unclear about how to use the technology. Regulators would be more certain in regulating the environment. So regulations are basically just really important. They can either really help the industry or kind of just stifle innovation and slow things down. Basically, there's a bunch of interesting things on this study. I won't go through all of them in this video, but what I want to bring your attention to here is specifically this piece of literature here, which says that regulatory uncertainty was actually found to have a positive effect on blockchain. And basically, this was a surprise to the researchers here because they thought it had a negative effect. But when they looked at it deeper, they found that regulations actually facilitate blockchain adoption. And then once a project is actually kicked off and in the market, that's when regulations actually are negative. So it's really interesting here. And I'm just driving the point home that regulations are just important. We want to keep an eye on them. Now, with that said, guys, I will go into some of the top regulations that I think you should be aware of, and also some of the coins that are tied to this regulation, which may be interesting for you to invest in. So cool, yeah, let's go into it. So the first regulation here is not specifically a banking and finance regulation, but it's more of a general regulation around sustainability. This came out pretty recently, actually, just the end of 2023, December 2023, I think. This regulation was specifically aimed at reducing greenwashing. Greenwashing is when a company, says they're sustainable, but they're actually not sustainable. So they're just kind of making it up. But they're telling the consumers, yeah, we don't use whale oil in our. I don't know where that example came from, but yeah, whale oil in our beauty cream. All our coffee is organic, but actually it's not organic. That kind of thing. So what this regulation basically says is that companies have to do a lot more in terms of reporting how they're actually sustainable and then passing that information on to investors and consumers. So I believe before it was voluntary, but now they're trying to make it so that it's absolutely mandatory that you have to do this, and you have to actually show more detailed information on how your products are actually sustainable. So of course, this applies to those investment products where they say invest in ESG only investments and equities and bonds and whatever stuff like that. So this applies to those products where they actually have to show investors and their consumers that their products are actually sustainable. So now that we know that, I'll go through some of the coins that may be used for the facilitation of these regulations or to be compliant with these regulations. So the first one here is Ethereum. Ethereum is involved in a bunch of different things, but particularly the reason why I suggest Ethereum here is because of EY, Ernst & Young, OpsChain, ESG. This is basically a platform for enterprise to help track their carbon credits through blockchain. It's using Ethereum, it's using some of EY's special own proprietary technology, but essentially it helps enterprise track carbon usage throughout their company through tokenization, and then they can take that and show to investors like, look, this is what we've done, it's clean. So that's one. So the second one here is POWR Ledger. So POWR Ledger, they have this particular product here, which is energy trading and traceability. So we just have a look at that briefly here. The platform tracks and trade, helps you track and trade, stay on top of your provenance and the flow of energy. It can give consumers a choice over their energy, peer-to-peer trading. It just helps with that, disclosing sustainability. Then the second one here, we have Energy Web Token. So if you look at some of the stuff they do here, we see they have green proofs. So it seems like they're providing transparency for organizations. They show that the commodities are clean, verifiable, with granular data. So yeah, doing the same sort of thing really. So that's something interesting to look at. Then we have Chia here as well. So Chia setting a new standard in blockchain technology. I see they're working with Climate Action Data Trust, some sustainability sort of consortiums here. So building efficient carbon markets. So I believe that they're trying to build the market where people are able to trade carbon credits on a blockchain sort of basis. So that is facilitating people to track those carbon credits and carbon accounting more, so that they may be able to sell those onto new markets like this and possibly earn more revenue. So they're kind of facilitating that. So those are some interesting ones to look at. So the next regulation we have here is the EU AI Act. So this is, I was quite surprised when I saw this. Actually, this was released only, I believe, a month ago or something like that, or just very recently. What this says is basically it's putting restrictions on AI using data. So depending on what type of AI it is, they categorize it into high risk, medium risk, low risk. And depending on the risk, they have certain restrictions on what data that AI can use to train itself. So I believe I'll give you an example here. In a low risk, in this specific case here, so it says providers of AI systems who tend to integrate the general purpose AI model in their AI, putting in place a policy to respect EU copyright law. So that's something that's quite interesting. I have a few friends who they're into drawing and art, and the whole AI thing has kind of put a real dampener on their mood around their career prospects. And if this is put into law, basically AI models which use copyrighted material to train itself, they can't do that anymore. So that's quite interesting. So what I'm saying here is basically any model that needs to train itself on data, they may need to prove, or they need to have some provenance or where that data came from. So depending on the model, if it's a big model that is using all kinds of data from everywhere, and they're in the EU, or maybe they're not in the EU, but they interact with EU customers, they have to show regulators where they got that data from and if it's compliant with this EU AI Act. So on that basis, let's have a look at some blockchains here which help with that data provenance aspect of that. So first one up here, we got Origin Trail. So this is a parachain. They basically do all things related to provenance, whether that be for physical stuff, containers, construction. They do, I believe they also track NFTs as well. And if we have a look here, scientific research, this is just one example, by the way, but they're basically saying that, if the industry is using AI and AI is collecting data from all these sort of low integrity sources of research and data, then the AI model is kind of not really useful in that way. So what the solution here is saying is that it provides a verifiable data origin, ownership, and discoverability using their platform. So they're really just filling the gap for that data provenance. So the next one here, we have Ocean Protocol. So this is they're building a data marketplace. So what this does is people can basically sell their data on the marketplace, and it's all transacted through the Ocean token. But what this does is it allows you to show where you got that data from, who used to own that data, and it just helps fill in that gap of the provenance there as well. Then we have VXV here. So I did a video on them previously, but they're doing some really cool stuff. So they have a language model, but they also have this cool pipeline sort of tech where they're able to show all the changes made to a particular model based on the data that it has ingested using blockchain transactions. So that is really building out the pipeline, just another way of showing that data provenance. Then we have a new one here, Swash. So this one is allowing you to own your own data. So what they have is like an application where you download it, you surf the web, and basically you get paid for surfing the web, because some certain websites, they will use your data to generate some insights, but they will pay you for that in the Swash token. It's kind of like Brave browser in a way, but I think Brave is more concerned with ads, Swash is more concerned with your actual data. So metadata and, all different types of data. So the next regulation is Basel III here. So this has to do with the liquidity of banks, basically. If we take that liquidity example, Basel III, is more than just liquidity. But if you just look at the liquidity issue as an example here, of course, we move over to XRP. XRP has been in the space since the beginning, basically. Their whole product is basically on-demand liquidity. And I don't know if it's still called that actually, but basically it's liquidity. And, you'll see that, just look at all their partners. Basically, they're partnered with over 500 banks all around the world. So XRP is one. Then we obviously have Stellar, XLM. So they're kind of like a sister to XRP. They're doing the same thing, whereas XRP is doing it between banks, XLM is doing it between people. So that's another one to look at. And then we have XDC here is another one as well. They're mainly focused with trade finance. So different banks, suppliers, manufacturers, shippers, whoever can go on the platform and transact in XDC. And because they're all on the same platform, all the data is all standardized on the platform, allowing them to do more automation and more real-time transactions, and it's just more efficient, faster, blah, blah, blah. So because it's more efficient, that kind of helps with the liquidity issues that the banks have. Then moving on to the next regulation here, we have EMIR, Dodd-Frank. So both of these came about basically after the great financial crisis. They particularly deal with derivatives, basically, and the tracking of derivatives and how transparent the transactions are of derivatives, and just everything about derivatives is what they're trying to regulate here. So when looking at derivatives here as an example, we essentially want to look for any blockchains that specifically deal with finance. and the tracking of financial transactions. So if we look at a couple of examples I have for you here, we have first one is Avalanche. So Avalanche, they do a bunch of different things, but they were previously partnered with JP Morgan to do some project basically, and they have a bunch of DeFi apps, and they're basically known for being more on the financial end of things. So that's one interesting one to look at. The next one we have here is the Injective Protocol. As you can see here, the blockchain built for finance, basically. You can see that, they're not only helping DeFi dApp developers build applications, but I can totally see this being used by centralized financial institutions that kind of want to level up. Maybe they want to have a competitive edge over their competitors, and they kind of see blockchain as this kind of path to that. So this is a really interesting one. I think I'm going to take a deeper look at this one myself. The next one here is XRP. Obviously XRP, you can track derivatives with it as well. So that's interesting one to look at if you haven't looked at it already. Then obviously we have Quant here. I'm invested in Quant as well, full disclosure. So with Quant, they're helping banks integrate their tech with blockchain. They're also helping blockchain integrate with other blockchains. And on top of that, they have the Overledger system, which kind of tracks all the transactions happening throughout that network. So that just helps with the whole tracking idea around the tracking of derivatives. So I suggest you have a look at Quant as well. They're pretty interesting. So those are the three sort of main sort of top regulations. I suggest you have a look at it more later in your own free time or whatever, when you're taking a bath or something like that. So anyway, so the regulations which are not facilitating blockchain adoption, basically you can think of them as being two sort of big regulations. So I'll go through them here really quickly. So the first one is obviously AML, KYC. There's a whole bunch of just different regulations and legislation about this in different countries. Basically, it says that the developers of dApps and stuff like that, if they have customers, they have to identify them. And the responsibility falls essentially on the on-ramps and the off-ramps of our space. So if you think about like Coinbase, Binance, MoonPay, any kind of service where you can use to buy blockchain, that is who is responsible for collecting AML, KYC data. So this doesn't really affect the space negative. I mean, it is negative, but it's not in the sense that it's stopping us from doing anything. It's just kind of slowing us down because people have to give all their information. They have to take a picture of their face. They have to give their passport. They have to kind of, do a picture with showing what date it is on the side. I don't know if you've done that, but that's just slowing down adoption. But it's not. There's nothing wrong with that. It's just for your own safety, right? So, or for the collective safety of society, if you can think about it that way. The other kind of big regulator in the space is the SEC. So, this always catches some mad hype on the internet. Basically, when the SEC does something about crypto, everybody looks at it. But basically, it's this whole uncertainty about what is a security and not a security. So the SEC basically uses the Howey test, which has some certain criteria which classifies an asset as a security or not a security. But it's not entirely clear because blockchain, it can start out as a security, but then transform into a commodity later on, which is what we saw with XRP or, with Ethereum as well. So, by the way, guys, if you want to see a video about what would happen if the SEC sued Ethereum, just let me know. And if you have any other kind of video ideas, just put it in the comments below. But yeah, I think that's it for this video, guys. Thanks very much for watching. I hope you enjoyed that. If you have any ideas about what else I should be doing on this channel, just let me know. It was cool. This felt a bit different, this video. I'm looking at the camera now, which is different. It's kind of weird because it's just like a thing that I'm looking at is just, yeah, it just feels weird. But it kind of feels like I'm in Big Brother actually. But yeah, anyway, thanks very much for watching the video, guys. I'll see you next time. Take care and yeah, have a good one.